All right, so we're now into the second part of this lecture on the economic context of social welfare policy, or what I've relabeled as sort of the fiscal context of social welfare policy. And so we're still building up towards understanding of how the EITC operates, but before we get there, I think we still need some more background and terminology. And so I know I said that this would be a two-part lecture. I want to go ahead and break up this last part into two further sections. And so we're going to end up with a three-part lecture here. And so in this section, we're still picking up more of the background and terminology. And so first, I'm making a case here for the various ways in which taxes may have an impact on low-income populations. I think you could probably do this off the top of your head about the different ways in which taxes may affect low-income populations. So certainly, we just got done talking about the progressivity or the regressivity of certain taxes. And so you'll note that the nature of the tax itself might have a disproportionate burden or impact on low-income populations. You can think in the way of how one gets back their taxes, in the way of tax credits, whether they're refundable or non-refundable, certainly may have an impact on low-income populations. And then you may make a case for indirect effects, namely that we generate revenues by assessing taxes, and we use those revenues eventually to administer our various social welfare policies and programs. And so, at least indirectly, we have an impact of our taxes on low-income populations. So. Lots of different ways we note here in which taxes might be relevant for the populations that we study in this course. And so we're noting some terminology here, and so we're talking about federal taxes and the federal EITC. The EITC is a tax credit, but before we even dive into the notion of a tax credit, we note that the tax credit is applied to your tax liability. In other words, we need to figure out how much a person owes in the way of taxes before we even discuss the notion of a tax credit. And so we're just pointing out here, I'm just illustrating here how one's taxes are in fact figured. And so one of the first things that we discuss here is a notion of an exemption versus a deduction. Exemptions and deductions, in a nutshell, we're talking about basic reductions in your taxable income based either on the number of people in your filing unit in the case of an exemption or based on the type of filing unit, whether you're filing as a single individual or head of household or a married couple filing jointly. And so these are basic reductions that will reduce your taxable income and in turn your tax liability before we even get to the idea of applying your tax credit to your tax liability. And so you'll note the various amounts. So these amounts vary from year to year depending on changes in average household income levels. And so in 2015, the exemption amount is $4,000. So by way of example, if you're a single parent and you have two kids, you're caring for two kids, you'll note that there are three exemptions. You're entitled to three exemptions when you're filing your federal taxes. And so you multiply 3 by the exemption amount for each individual, $4,000, and you come up with $12,000. The idea here is that your taxable income is immediately reduced by $12,000 based on the fact that you're caring for 3 individuals. And then you have your standard deductions. We have both standard and calculated deductions. Your standard deduction is based on the type of filing unit. And the thinking here is that you have different types of families or households and different levels of non-discretionary spending. That is, expenses for which you have no control over. And so these are thought to sort of compensate you for the amount of spending that you're incurring. And so you can see the different amounts for if you're a single individual versus head of household versus a married couple filing jointly. Of course, it's thought that you have greater expenses if you're a married couple, right, filing jointly. And so this reflects what's assumed to be a greater non-discretionary spending level. And then the federal government will allow you further reductions. Right, if your spending exceeds that of the average individual, right, if you can claim your standard deduction, or you can itemize your deductions. That is, if you're incurring additional expenses aside from these non-discretionary expenses, there are certain expenses to which you might be entitled to further reductions in your taxable income. And so I've noted a few examples here. So things like charitable contributions. If you've made a donation to a 501c3 entity that is a nonprofit organization in the last year, you may be entitled to a calculated deduction or a tax write-off, in other words. And then medical expenses, moving expenses, there are different classes of expenses to which you might be entitled to greater reductions in your taxable income than what might be allowed under your standard deductions that are noted here. And so the major point here being that your exemptions and deductions, effectively, they'll reduce the amount of your taxable income, which in turn is figured, which in turn is used to figure your tax liability. And so when your tax liability is figured, that's when the tax credit comes into play. And so exemptions and deductions are applied to your taxable income, but your tax credits are, of course, applied to your tax liability, or how much you owe in the way of taxes. And so your tax credits can be either refundable or non-refundable, and you can certainly reason through which one might be more favorable for the lower income worker. Let me just note here that non-refundable tax credits certainly can be beneficial. If you think of the amount of taxes you owe, let's say you're a low-income individual. Typically, you're not going to owe much in the way of taxes if you're a low-income individual. So if you have a non-refundable tax credit, right? If you have a non-refundable tax credit and you don't owe anything in the way of taxes, that's not really going to help you much if you're a low-income person. But of course, if you're a higher-income worker and you have a non-refundable tax credit, typically, if you're a higher-income worker, you owe more in the way of taxes, and so non-refundable tax credits are still beneficial for you. But certainly, we make the case here that refundable tax credits are favorable for the lower-income worker. We want refundable tax credits in the way of the tax credits for low-income populations. All right, so we're here in this section. I'm just trying to illustrate here just an example of how one's taxes are figured. And so, depending on your level of taxable income, so after applicable exemptions and deductions, you'll figure your taxable income or your adjusted gross income amount. And so, based on your level of adjusted gross income, you can see what tax bracket you're in, right? So, if you're making $50,000, right? If you have $50,000 in the way of taxable income, you're in between these, as a single individual, that is, you're in between these amounts, these bend points, right? $37,450 and $90,750. The way this marginal tax, this tax schedule works is that on the first dollar of taxable income, you're going to get taxed at 10%, so 10 cents on the first dollar that you earn in the way of taxable income. On the second dollar, you're assessed another 10 cents. On the third dollar, another 10 cents, all the way up to this bend point here, $9,225 in the way of taxable income, at which point your marginal tax rate shifts to 15%. So on $9,226, you're going to be paying at 15% or 15 cents on that dollar. $9,227, you're going to be paying 15 cents on that dollar, all the way up to $37,450. At which point your marginal tax rate goes up. On $37,451, you're going to pay 25 cents, and so on and so forth. And so I'm not going to ask you to calculate tax liability. This is all just to understand, just by way of background, how one's taxes are actually figured. The amount of tax liability is actually figured. And so I was taking you through the example of a single individual. Right? I was taking you through the example of a single individual who has $50,000 in the way of taxable income. So after applicable exemptions and deductions, you have $50,000 of taxable income, and what that person might owe in the way of federal taxes. And so we noted that we have a 10% tax on the first $9,225. So up to $9,225 of taxable income, you're going to owe 10%, or this amount here, $922.50. And so from $9,225 to $37,450, and if you take that difference, that amount is $28,225. You're going to be taxed at a rate of 15%, and so that's what I've calculated here, 15% of the next $28,225. That amount comes out to $4,233.75. And then on the difference between $50,000 of taxable income and that last bend point, so difference between $50,000 and $37,450, right? You're going to be taxed at 25% or 25 cents on each of those dollars. And so that's what I've calculated here. That difference comes out to $12,550. And so that amount is indicated in parentheses if you add up those amounts. Okay, if you add up those amounts and recall the big picture here, we're trying to figure out how much a person owes in the way of taxes. If you have $50,000 of taxable income, how much does that person owe in the way of taxes to the federal government? Well, that person is going to owe $8,293.75. Okay, so that's what we mean by tax liability. That's how taxes get figured. And so I just want to make one last point here about tax liability, and that's that we distinguish sometimes between actual tax rates and marginal tax rates. We just noted that that person, that $50,000 earner in the way of taxable income, was in the 25% tax bracket. Right? We noted that this person's taxable income falls within this section here. And so while the marginal tax rate for this person earning $50,000 in the way of taxable income is in fact 25%, if you were to figure this person's actual tax rate, right, the actual taxes paid by this person was in fact, we have the amount here, $8,293.75. If you're assessing that amount as a proportion of this person's taxable income to figure a precise tax rate, an actual tax rate for this person, in other words, that tax rate actually comes out to 16.59%. Right? So while the marginal tax rate for this person is in the 25% tax bracket, this person is actually paying at a rate of 16.59%. So there's a discrepancy between actual tax rates and marginal tax rates, and this is illustrated, certainly was illustrated in the last presidential elections when there was this whole issue about Mitt Romney's actual tax rate. He was certainly in the highest tax bracket, right? He was in this highest tax bracket. He was in the highest tax bracket. I'm trying to go back here. So we're going back to the highest. He was certainly in the highest tax bracket, but everyone was making a big deal about his actual tax rate being much lower in the 20% range. And so you can think about all the different things that might go into an actual tax rate calculation that would reduce his overall tax liability to that level. Okay? And so, all right, so I end this section with a quick exercise. So if you want, if you're following along here in the section about tax liability, you can go through and take an example. I give you an example of a single mom with 2 kids with $25,000 in the way of gross income. And so you can go through this calculation here. Okay, and so I'm not going to test you on tax liability. The whole point is that we're trying to understand how tax credits operate. And so first, I just gave an illustration here about how taxes are actually calculated.